Hey, how's it going? My name's Nick. Just wanted to take some time. I saw this show called Anatomy of a Trade, which basically went over different strategies that involved options. And they basically showed a graph that had the break evens and thought processes of like how they were adjusting their trade using options to reduce cost basis and eventually make profits. And so what I wanted to do was just demonstrate like the same concept, just using my portfolio and my strategies that I currently have right now. And so what I did was I just created a table that showed two strategies that I have, which is a strangle in Uber, and then also a covered call in Peloton. And so I wanted to just take the opportunity to educate, provide some insight and knowledge. That way, if you guys are ever thinking about how these strategies work, if you're thinking of it as a scam, or you guys want to just learn more about like how to reduce cost basis based on someone who's had experience doing this, I just wanted to show these two strategies here. So we'll talk about the Peloton cover call first. You'll see here that I initiated a covered call on November 3rd, which, if you don't know what a covered call is you buy 100 shares of Peloton, and then you sell a call out of the money against the 100 shares. So the idea being is that if you have a strike price above the 100 share current price, then if the price appreciates up to the strike that you sold the option at, you'll actually make a profit on the premium that you sold and also the stock appreciation. 100 it'd be $1 per 1 cent that the stock appreciates up to the strike price. And so basically what I did is on November 3rd, I initiated a covered call position. And as you see, the average stock price right here is about $6.03 is when I bought, is the average price that I bought 100 shares. And so I didn't buy all 100 at once. But you see the average stock price was around $6.03. So you can tell that I actually bought 100 shares eventually at as the price was going down, which is very unfortunate, but life happens. And so you'll see that the closing price was $5.21. Now, I initially, when I sold the contract, I received 18 cents in premium, which is $18. And it may not seem like a lot, but if you think about it, the average stock price is $6.03. So that means out of the 100 shares that I bought, on average, if you were to sell them, you would sell them at about six, or if you were to value all the shares that I bought over time, they'd be valued about $6.03 per share. Now, the cool thing about having this 18 cents of credit is that now instead of each stock being worth about $6.03, you can actually offset the 100 shares of stock, the average price, and bring it down even lower with the credit that you received. So that's what's happening here is that you see that the break-even price actually went down to $5.85. And so as you see, the stock price, so I sold it out of the money call option, but in this strategy, you want the price to go up slightly, right? But in this case, this actually poo-pooed and went down from $5.21, which is the current price as of November 3rd, and then dropped down all the way from $5.21 down to $4.46. So this was actually a very much the opposite of what I wanted this strategy to do, which is okay because thankfully, if you sold an out of the money option, you can actually lower the strike price in order to receive more credit if you were to sell within the same expiration date. And so the cool thing about this is that I received 16 cents more credit, which again doesn't sound like a lot, but it lowers my break-even point to where it's 34 cents less than what my average stock price is. So instead of me breaking even at $6.03, now I can break even at $5.69, which is cool because maybe the stock price will eventually go up, right? Well, it actually did on November 10th. It went from $4.46 to $4.53. And then you'll see that I was thinking that this stock price is pretty much going to stay around $5, at least below $5. So what I did was I eventually kept rolling down my option from $7 or $6.50 to $6 to $5 to receive more credit to increase my break-even price, because it was at $5.85. And then now it's all the way down. If I were to roll down all the way to $5 strikes, break even would be $5.56, which is much better than $6.03. Now, this was all working out perfectly until for some reason, Peloton had this new surge in energy. And so the price went from $4.44 to $5.14, which is actually pretty insane. If you look at the price movement for that, you would see that that's an increase of about 16% in one day. But wait, there's more, because the next day it went up another 40 cents, which if you look here, you'll see that in 2 days it went up 24%. So yeah, I got the bullish move that I was looking for, but unfortunately, as I kept rolling down, my break even was going to get challenged. And so what happens is that, yes, I did reach the break even point, but now I'm limiting my upside gain because the break even is so much lower that I actually need the price to stay still, to stay below my break even in order to maximize profit, or at least stay at the break even point. But of course, nature doesn't really work that way. The price kept going up, and just stayed stagnant. So as the option was approaching expiration, because as you see here, I sold about I think the 40-day, 38-day expiration on November 3rd. What happens is that about 25 days has passed. So now the expiration date's closely approaching. And so I had this option. I could either roll out in time or I could just take the loss. And so I just rolled out in time simply because I want to increase the strike price in order to at least make a profit out of this. Now, the question came, should I increase the strike or should I keep it at the same $5 strike? And basically it's just a question of, do I think the stock is more likely to go up or more likely to go down? And now nobody can read the market. Be the first one to admit that. It's just a game of what do you think is most likely to happen? I think the stock market's going to go up, at least for this one. Thought process being, if I go to Peloton, you'll see here that this RSI, which is basically a measurement of momentum, has been oversold multiple times within the past couple months. So in September, you see the RSI reached down to almost 20, which is almost a 2 standard deviation drop in momentum. This one went to 25 again in September, or late September. Rose up to the top, or rose up to the middle at 50, which means that it's neither overbought nor oversold. There's no real momentum either way, which you can see in the stock price. It's actually been pretty stagnant, which shows why it's at 50. Went back down, went back up, finally broke that 50 mark, went back down because it got resistance, but then it went back up again. This average line right here that smooths out all this noise shows that it's above 50. So this kind of gives me some indication that it ran out of sellers and now it's going to increase the number of buyers on a momentum basis. So I just think that if I were to decide whether to stay at the $5 mark for the strike or to move it up, I'm more likely to move it up. So I did. I moved it up to the $7. And so what I'm thinking here is that similar to the past where it reached bottoms, it reached the bottom, it's reached the bottom on this RSI, it eventually bounced up to become overbought, went back down, went up, went down, went up. And so you see that there's kind of this cycle where if you goes to one extreme, it at least goes to some type of bullish momentum. And you see that here it has a lot of just back and forth. So I would say every time it's gone, even when it's gone down here, you see that there was some kind of retrace back up. So even though this was going down, you saw that there was a slight jump, which I think is perfect opportunity to try to capitalize on this movement. Now, again, I may be wrong, but it's just I think this is how the stock is more likely to move. And the other thought process is that if I sell a strike, a $7 strike, if this stock does go down, I could just always roll back down again, similar to what I was doing in this previous scenario. So the credit just keeps building, building, and building as I keep rolling down again. So even if the stock price does go down, I have some type of protection going down as well. And so currently, I started off with 18 cents of credit, went up to about 47 cents of credit. But then in order to get to the $7 strike, I rolled out in time. It cost me about 58 cents in debit to make that transaction. So now I'm currently at a negative credit, which actually raises my break even from $6.03 to $6.14. But that's okay because of my current thesis. If the stock price continues to go up, hopefully it goes up past my my break even of $6.14 and eventually goes to $7. Because if it goes to $7, theoretically, I could make a profit of about 86 cents on the stock price going. That meaning that if I have my $7 strike goes up to there, I have my break even at $6.14. I have 86 cents up per 100 shares. I do have to offset that against the $11 that I had to pay for this, but the total profit would be about $75, which $75 on a break even on a shares of 100 or $6.03 per 100 shares. My total principal would be $6.03 times 100, $603. And if I divide the $75 profit divided by the 603, I would make about 12% in a matter of 1 to 2 months, which, in my opinion, is a pretty good return on capital for this trade. So this could be my potential profit, percentage of profit. So I'm willing to take the risk that the stock price goes up, at least to $7. So at a maximum, I can make 12% profit. This next strategy that I have is the Uber Strangle. So again, another stock that I personally like because it has high volatility, which also means it has pretty decent premiums. The strangle, if you're not aware of what a strangle is, it's basically selling an out of the money call and out of the money put with no stock purchase. And so what you're doing here is you're just collecting purely credits in order to, at expiration, expect this. Hopefully, the stock price would stay between the upper bound of your call and the lower bound of your puts. And so with this credit, you actually have a break-even price of whatever your strike price is plus and minus whatever credit you receive. So on the call side, the upper bound, my break-even will be $57.10 because that's $56 plus the $1.10. That's $57.10. On the downside, I have an extra $1.10 of protection at $42.90 at the start of this trade. The stock started out at $49, and like true bullish herd mentality, Uber never went down in the 14 plus days that I had this stock. So not ideal because what's happening is that it's pressing up against my upper bound call strike. And so what I was doing to offset the increase in price was I kept rolling up the untested side. So it's on November 10th, I raised the strike from $44 on the put to $46, which granted me an extra 23 cents of credit. So now my break even was going down. I was going up actually on the call side and going break even was increasing on the put side, but it's also getting wider, as you can see here. And so the stock price kept going up, kept going up, kept going up, kept going up, 14 days straight of just going up, to eventually where it reached my my call strike price. So the call strike price right here is actually at 56. The stock price started at $49.50, kept going up, and towards the end, like on November 25th, it actually reached this the strike price. But as you see here, I actually, as the price kept going up, I kept adjusting my put side to receive more credit. And so as you can see, the break even's actually getting further and further away from the actual strike price. That's because we kept collecting premium here. Now, what happened was that, yes, the stock price went up 14 days straight. However, that means 14 days has passed, which increased the amount of decay that I had on these options. And so what I did is that as these were approaching around, I think it was like 24 days, I actually rolled out into time to allow me to increase the number, to increase the strikes, so that way there's a little bit more of a wider break even on the strike side. So what you see here is that on November 28th, I've actually increased the call. So I rolled it out to about 55 days, moved the strike from $56 to $57.50. On the put side, I moved the put from $56 down to $50. And by doing so, I actually had to purchase about $1.08 in premium. So I actually had to buy instead of receiving a credit, which is fine though, because by the time that I had to roll, the credit received went from $1.10 to $3.57. And so what I did here is I actually purchased $1.08, which actually decreased the amount of credit that I received from 357 down to 235. But that's fine because now my break even, or my amount of credit has been increased from 110 to 235, which is almost double from when I originally started. And I was able to widen the strikes. And so what you see here is that there's, on this blue line, the call and the break even, the yellow, has actually gotten wider as time has passed by because of the amount of credits that I received. And so you see here that it starts off pretty narrow. As time passes by, you see that this width has actually increased quite significantly, about 100% actually. Same thing on the put side. So as I kept rolling up, you saw that the break even was getting wider, but the break even is also rising up with the put increasing in strike price. And so as it's gotten wider and towards expiration, I actually bought the guts, which is what is a terminology I've heard before, and I just widen the strike prices, which is called selling the wings. So widen the strikes, but also I got to keep a lot of the break-even gap between the strike and the actual break-even point. Compare it to here, it's kind of thin. Here it's pretty wide, kind of thin in the beginning. So the thought process is that even on this second cycle of rolling out my options in time, I've widened the strikes. I've also widened the break-even point. So even if this stock keeps challenging either the upper bound or lower bound strike, I'm actually increasing my probability of making a profit simply because I'm collecting premium. So even if the stock were to keep going up, well, what I could do is I could keep rolling this side up even further and further. If the stock does continue to go up for another 14 days, I could keep doing this, collect more premium, and my break-even price will keep going from $2.35, potentially maybe like $3, $4. If the stock were to crash, that's fine. That's why I put a bias towards a downside movement, because after 14 days of going up, I would think over the next 52 days that I have these strike prices, I think more than likely it will go back down, or at least stay neutral, because 14 days straight of going up is not very, it's not very likely that it'll continue to keep going up. Now it could. I mean, I've seen Roku do more life-defying stunts, like going up from $54 to over $100 in a matter of, see, November 1st, it's November 28th, so 27 days, it's gone up 100%. So I've seen crazier. But even then, like, I don't think that this has a lot of momentum to keep continuing. But it could. But in this case, like Uber, for example, has literally never seen a red, maybe like this pixel of red and this pixel of red, but every other day since October 27th has seen an update. And so with this RSI showing that it's at about 80, which is like exactly, I think, 2 standard deviations of just upward momentum, it's completely overbought. And so over the next, if you want to see this stock price continue to go up and up, like this RSI would probably have to go up to like 90, which I don't think is very likely. I think it's going to instead going to at least retrace down and stay stagnant. That's the way that this thing goes down. Or if this stock price drops, this will also go down as well. So I think there's a better chance of this thing actually falling, which is why when I rolled out into time, I increased the call strike price from $56 to $57, which is only a $1.50 increase. But the put side, I moved down from 56 to 50, which is a $6 drop versus a $5 increase on the call side. So this is how I'm currently managing this trade. We'll see if I'm right. If I'm not, then, well, guess I'll keep adjusting until I'm right. Just increasing my break evens, and we'll continue to see what happens. So yeah, this is my thought process. I will try to update as I have time, and see if this is worth it. I also like to just record this to show my own like thought process and emotional standpoint, just to see like what's happening. Maybe in a year from now, it'll be kind of worthwhile to look back on my thoughts. So hopefully you guys like this. Let me know if you have any questions. I'll be more than happy to explain. And I'll just go through this journey together. So thanks for listening, and hopefully this was something helpful to you. If you guys like it, let me know what you guys think. All right, talk to you guys soon.